Hello, everybody. Thank you for joining. So today we're going to dig into the exciting world of ESG and sustainability funds. We're going to look at where money is going. In other words, what strategies are attracting capital. And secondly, we're going to dig into the performance of these funds. We're also going to hone in on climate strategies in particular and better understand what the current geopolitical environment means for the energy transition. Now, before I dig in, just a quick introduction. So I cover ESG for Bloomberg Intelligence, which is Bloomberg's research team. I sort of describe my job as taking Bloomberg's ESG data and providing analysis into it. So writing about trends, drivers, basically how our clients can use this data when they're making investment decisions. So let's dig straight in. When it comes to sustainable funds, where are assets and flows going? So on the screen, we see that assets in global ESG and sustainability funds crossed about 3.4 trillion in the first half of this year. Now, we also see that about 85% of these assets, so the yellow bar, is Europe. Now, I always knew Europe was dominant. I don't think I expected it to be this much. So North America is somewhere close to 10%, and APAC is about between 5 and 7%. So just a line on what goes into this chart. So we're really tracking assets into all publicly traded funds. So think ETFs and mutual funds. And what we're really looking for is ESG labeled funds. So ESG, climate sustainability, whatever you want to call it, in the name or benchmark of the fund. So this is not, the broad ESG integration. These are ones where ESG is specifically in the name of the fund. So ESG sustainability, etc. Now, to paint a better picture of demand, let's look at where flows are going. So such funds in the first half of this year saw about 5 billion in outflows. Now, while there's still outflows, as you can see, this is much less than the 110 billion of outflows that we saw in 2025. Now, 2025 is a very different story, right? It's our first year of outflows after years and years of net inflows, most of which are above 100 billion. I'll give a reason for these 2025 outflows. So a lot of it, climate strategies in 2025, the political uncertainty caused investors to pull out, especially in North America. And the second piece is that about half of these outflows actually moved out of publicly managed funds, out of ETFs and mutual funds, and into separately managed accounts. So they are still ESG strategies. They just moved out of the public markets into separately managed accounts that we don't track. So in a way overstated, but still net of everything, we did see outflows in 25. Now, coming back to the first half of this year, even though we see outflows, there are a couple of bright spots that still emerge. The first one is ETFs. ETFs took about 24 billion in inflows. So it's very clear that investors still prefer these low-cost, transparent strategies. And fixed income saw about 14 billion inflows. So obviously equity and non-ETFs saw outflows. When we look at themes, the first half of this year was really all about clean energy. Clean energy saw about 10 billion in flows just in the first half this year. Now, I say this is a near record because we've never seen the first half be this much except for 2020 when Biden came into power. So again, near record flows, all of this driven by performance. So in the chart to the right, we have the S&P Clean Energy Transition Index. And what we really see is outperformance. So clean energy was one of the best performing themes of 2025. And the first few months of 26, we've seen a bit of a downtrend after. And all of this driven by the AI-driven power demand. So AI, obviously, we've heard about this unsatiated need for energy, and that's really favoring anything that is fast to deploy. So think renewables like solar and batteries. A colleague of mine once said that right now anything that produces electrons and produces it fast is where it's at, and we can see that in this chart. Another theme is transition metal funds. So transition metal funds saw about 1.6 billion inflows. Now, that might not seem like it's too much, but it's 10 funds. We have 10 transition metal funds. So given that small number, 1.6 billion is quite a lot. And again, you can see the same trend. You can see the same trend of electrifications as renewables outperform the metals that go into grid build-out, energy storage, etc. Metals like copper and lithium, those are the ones that outperformed and saw flows. Now, I don't think we can talk about ESG funds without talking about rebrandings. So on this chart, we can see that about 20% of funds have rebranded away from ESG. So that's that red and pink bar that you see. About half of these dropped ESG from the name, and the other half changed labels. They went from things like ESG to alternate labels like screened or leaders or whatever that means. Now, all of this driven by ESMA regulations in Europe. So 90% of these rebrandings are all European funds. So ESMA regulations in Europe require funds domiciled there that have ESG in the name to meet stringent regulatory criteria. So funds went ahead and dropped the name as a result of that. Now, coming to a second topic, which is performance. How have these funds performed? We've tracked US allocated funds, and what we see in the chart to the left is over 1 year, 12% of funds have beaten benchmarks. Now, that's not good. That's a low number. But if we look in the chart to the right, we can see that outperformance really comes during periods of drawdown. So periods when the market goes into a downward spiral, the peak to trough value. Now, we can see that in 3 of the 4 largest drawdowns we've seen since 2015, over 60% of funds have outperformed and beaten benchmark. So that leads me to believe that such funds tend to outperform when the markets go down and they fail to keep up in a bull market. And when we asked ourselves the question why, we find that's because of ESG funds' factor exposures. So such funds tend to tilt towards factors like quality. So these are companies with high profitability, and they also tilt towards low volatility. And that's just how these factors behave. They tend to outperform during down markets and underperform during bull markets. And I think that what explains this space in a good way. Now, let's dig into clean energy in particular. So when we saw those 10 billion inflows, I asked myself the question, is this sustainable? And over the long term, we do think that, the current geopolitical tension, energy price spikes, they are positive for renewables because they make renewables relatively more cost effective. Over the short term, we do see mixed signals. So what we've done here is we took companies most held in clean energy funds, and we evaluated them across a couple of fundamental and technical metrics. So what we can see here is that while clean energy has lost price momentum, to some extent we saw it falling off the curve a little bit, it's now performing in line with the market. Earnings are still accelerating, which is the green bar when it comes to earnings trends. In other words, for these groups of companies, earnings over the next 12 months are expected to increase faster than the previous 12 months. So earnings acceleration can continue to support these companies. However, revision breadth is negative. Revision breadth is earnings expectations today versus 3 months ago. So in other words, analysts were more optimistic about clean energy 3 months ago than they are today. So that gives us this mixed signals where we have earnings accelerating, but the trend is decreasing because revisions are going down. So it's really a mixed trend that we see going forward. Next is another very interesting trend when it comes to clean energy. So the blue line, which is this S&P Clean Energy Index, you can see it typically moves inversely to real yields. So real yields, so clean energy being capital intensive is inversely related to discount rates. So you have higher discount rates, you have lower returns. For the first time in 2025, we see clean energy outperform despite real yields not falling. And if you can see from 2014, we haven't seen that before. Every time clean energy outperformed, it was real yields coming down. And that suggests this structural demand driver that I talked about, this AI-driven power demand that was coming in and lifting all these stocks up despite real yields not falling. We do see rate sensitivity coming back. Again, we said that clean energy is coming down as of the end of this chart. And that's really this AI-driven power demand. In my mind, I think it's being tested a little bit. We have to see this AI-driven power demand convert into earnings for clean energy. I think that's happening, but because of bottlenecks and execution delays, that's not happening to the extent that investors perhaps hoped. Last topic that I'll touch upon is what I call this sustainable or ESG misfits. So these are companies that are very popular in ESG funds, but have red flags. So it's almost what I call overlooked risks. So here, for example, we have companies like Rivian, McCormick. These are companies that are popular in ESG funds, despite having governance red flags. So these companies have a dual CEO, which means that the chairman is also the CEO, which compromises on independence. And they have unequal voting rights, which means shareholder rights is concentrated amongst a select few. Again, these two together are governance red flags. But still, we see that these companies have an ESG fund inclusion rate, which is quite high. Now, this metric is measuring the number of ESG funds owning a company divided by all funds. So a number of 10 means 1 in 10 funds owning the company is ESG, 10%, 1 divided by 10. And that's quite a high number. And we really find this across the board. We find a number of companies in ESG and sustainability funds with a lot of governance red flags. So to me, that's a overlooked risk within sustainability fund holdings. My last slide is another risk within fund holdings, which is divestment risk. Now, I think as AI power demand, energy security, the political landscape keeps evolving, I think companies are going to keep rolling back on their climate reduction goals. An unintended consequence of that is divestment risk from a company's ESG investor base. In other words, it's the amount of a company's market cap owned by ESG or climate investors that could sell if they roll back on their goals. So the example here is to the bottom, we have Scotiabank, which was the most recent to roll back their financed emission goals. Now here we can see that only 0.74% of the company is owned by ESG investors. So that's not much. But what if a Swiss Prime or an ISS towards the top of the chart were to roll back? These are companies where over 5% of their market cap is owned by ESG or climate funds. Quite a big risk if they decide to roll back their climate goals. So that brings me to the end of my presentation. I think maybe 3 takeaways. So the first one is the first half of this year was all about clean energy, though I think there are some risks going forward. The second one is sustainable funds tend to outperform during market downturns, but they fail to keep up when the market heats up. And last but not the least, divestment risk. I think that's going to become increasingly important to monitor going forward. And I'll leave you with one thing I always tell clients, which is that whether you're an ESG investor or not, you should know when there's concentration within your investor base. So if a substantial amount is held by ESG funds, I think every investor should be tracking that and monitoring that. Thank you, everybody. Enjoy the rest of the session.